$9.5 billion is sitting on a bet against the yen, and almost nobody covering crypto's institutional story is pricing in what happens if that bet unwinds. That's not a fringe number. That's approaching the largest short yen positioning global hedge funds have carried since 2007. Here's the carry collapse story nobody's telling you. Let's slow down because the mechanism here isn't complicated once you strip the jargon off it. Think of a carry trade as simply borrowing money where it's cheap and putting it to work where it earns more, the way you'd take out a low interest loan to fund something that pays you back at a higher rate. For years, Japan has been that cheap borrowing source. Interest rates there stayed near zero, while yields almost everywhere else, including in dollar assets, sat meaningfully higher. Global funds borrowed yen, converted it to dollars, and deployed that capital into higher yielding positions, including the exact institutional infrastructure being built around digital assets right now. In plain terms, a huge slice of the capital funding today's institutional crypto buildout is borrowed yen, quietly in the background, and most retail coverage never mentions it. Here's what that actually means for you as someone tracking XRP and the broader institutional narrative. The Bank of Japan has been raising rates slowly but consistently, and Japanese government bond yields, the return investors demand to hold Japan's debt, have been climbing right alongside that policy shift. Most people hear bond yields rising and tune out. Don't tune out on this one. When the cost of that cheap yen funding rises, the carry trade math that made this whole structure profitable starts breaking down. Positions that made sense at near zero rates stop making sense. That's when funds start unwinding, converting dollar assets back into yen to repay what they borrowed, and large, fast unwinds don't stay contained to Japan. Put simply, this isn't a Japan story. It's a global leverage story, and crypto's institutional infrastructure sits downstream of it, whether the narrative accounts for that or not. Let's go into the mechanics of why this matters specifically for the institutional crypto story right now. A haircut is simply the discount a lender applies to the value of collateral posted against a loan. When funding costs spike and volatility rises, haircuts widen across the board, forcing leveraged positions to post more collateral or liquidate. Here's the part they aren't telling you. This isn't theoretical positioning risk. Current short yen contracts sit at roughly 124,000, worth close to $9.5 billion, and analysts tracking this describe conditions as gradually accumulating toward a disorderly unwind rather than a controlled one. That's not a guess. That's how the ledger is coded when funding currencies get this stretched. Strip away the institutional language, and here is what is actually happening. Banks and institutions have spent this year building custody rails, clearing pathways, and stablecoin infrastructure around digital assets, much of it funded by capital that's cheaper today than it may be in 6 months. In plain terms, the institutional crypto build-out everyone's celebrating is partly running on borrowed yen, and that funding source is getting more expensive by the quarter. Now, here's where this connects directly to numbers you can actually see in the market today. Most people hear digital asset market structure and think it's all one story moving together. It isn't. RLUSD, Ripple's stablecoin, has climbed toward $1.6 billion in market cap, making it one of the largest regulated dollar stablecoins in the space. That's real institutional plumbing getting adopted. But here's the disconnect retail keeps missing. While RLUSD keeps pulling in net inflows, XRP funds have recorded outflows in the same stretch. Banks are using the rails. That doesn't mean they're buying the asset that rides on top of them. Here's what that actually means for you. Institutional adoption of the plumbing and institutional demand for XRP itself are two separate trend lines right now, and conflating them is exactly the mistake driving unrealistic price expectations. Add the carry trade risk on top of that disconnect, and you get a clearer picture of why price action has stayed muted even as headline adoption stories keep stacking up. Let's talk about what Tier 1 liquidity providers actually do when funding costs start climbing like this, because the theory turns into balance sheet decisions fast. Cross-border corridor balances, the running tally of capital parked in a payment corridor waiting to settle, get reassessed constantly against funding cost. When yen-funded capital gets more expensive, Treasury desks pull back corridor exposure before they pull back anything customer-facing. That's a quiet internal process. It doesn't make headlines. It shows up months later as slower than expected institutional flow numbers. there's a piece of this that almost never gets explained clearly, and it's about how leverage actually behaves once it starts unwinding rather than just accumulating. Think of leverage as simply using borrowed money to control a bigger position than your own capital alone would allow, the way a small down payment lets you control an entire house. When a leveraged position gets forced to unwind, it doesn't happen gradually and evenly. It happens in clusters because one liquidation often forces the next one, and each round of selling can trigger the margin calls behind it. That's the mechanism analysts are watching for right now. Current positioning hasn't triggered a disorderly cascade yet. It's sitting in what's being described as a transitional accumulation phase, meaning the conditions are stacking up without having fully escalated. Here's what that actually means for you. This isn't a prediction that a crash is imminent. It's a structural risk sitting underneath institutional crypto infrastructure that almost nobody is naming out loud. Put simply, the same cheap capital that funded this year's custody buildouts, clearing pathways, and stablecoin expansion is the capital most exposed if funding costs keep climbing and positions start unwinding in clusters instead of gradually. That doesn't mean institutional adoption reverses. It means the pace of it stays tied to a macro variable most crypto-focused coverage isn't tracking at all. So here's your systemic defense blueprint, the part you can actually use going forward. Stop treating institutional crypto adoption as a single uniform trend. Track RLUSD and stablecoin flows separately from XRP fund flows because banks embracing the rails doesn't mechanically translate to demand for the asset. Watch USD, JPY, and Japanese government bond yields the same way you'd watch a Federal Reserve rate decision. A disorderly yen unwind is the macro tail risk sitting underneath this entire institutional narrative, and it isn't priced into most crypto coverage at all. And when ETF inflow numbers come in below forecast, don't default to sentiment turned bearish. Check funding costs first. The math behind leverage positioning often explains more than the headlines do. That's the carry trade nobody's pricing into crypto's institutional story. Not because it's hidden, because almost nobody covering this space is looking at it.